Something strange just happened in the silver market. And I mean genuinely bizarre. The kind of move that makes seasoned traders stop and recheck their screens 3 times. Silver dropped hard on what looked like coordinated selling, the usual playbook. Dump enough contracts in a thin market and watch the dominoes fall. But here's where it gets interesting. Within 36 hours, every single ounce that got shaken loose was absorbed. Not slowly, not tentatively, aggressively, like someone was waiting for exactly that moment. This isn't normal market behavior. This is what happens when the underlying fundamentals are so tight that every attempt to create fear becomes a buying opportunity. And if you're holding physical gold or silver right now or thinking about it, you need to understand what's actually happening beneath the surface noise. Because 2026 might be the year this powder keg finally ignites. I'm not here to sell you dreams or make wild predictions. I'm here to walk you through the mechanics of what's building, the patterns, the pressure points, the places where this market could fracture. This is educational content about risk management in commodity markets, not financial advice. Let's start with what everyone's missing. The attention problem. Here's the paradox. Gold has been making headlines, breaking records, getting mainstream coverage. Meanwhile, silver's been quietly doing something far more interesting. It's been consolidating at elevated levels without collapsing back to the lows. That might sound boring, but in market terms, it's screaming. When a commodity gets pushed down and immediately bounces back, that's retail enthusiasm. When it gets pushed down and grinds back slowly over weeks, that's institutional positioning. But when it gets pushed down and snaps back like a rubber band within hours or days, repeatedly, that's structural shortage behavior. The crowd is still focused on gold because gold is setting records. They're not watching silver because silver hasn't exploded yet. But that's exactly when you should be watching. The explosive moves don't happen when everyone's excited. They happen when nobody's paying attention and the people who actually need the metal suddenly realize they can't wait anymore. Here's your first checkpoint. Who actually needs silver? Not wants. Needs. That distinction matters because want can wait, need cannot. The industrial hunger nobody talks about. Everyone knows silver has industrial uses. Solar panels, electronics, medical applications. That's the talking point version. But let's talk about the reality that keeps supply chain managers awake at night. Silver isn't just used in products. Silver is mission critical in thousands of manufacturing processes where there is no viable substitute at scale. You can't just swap it out because the price went up. The performance characteristics are often irreplaceable. Electrical conductivity, thermal properties, antimicrobial effects, reflectivity, these aren't luxury features. They're engineering requirements. And here's where it gets uncomfortable for the paper market. Industrial users don't trade silver. They consume it permanently. It goes into products that get distributed globally, buried in devices, embedded in infrastructure. It doesn't come back. This is not a recycling-friendly use case for most applications. You can't extract the microscopic amount of silver from a circuit board economically when it was worth $30 an ounce. But what about when it's worth 80, 100, 200? The math still does not work for most applications because the cost of recovery exceeds the value even at higher prices. So industrial demand is effectively one-way consumption. And that consumption has been growing, not slowly, rapidly, especially in sectors tied to electrification, renewable energy, and advanced electronics. Now overlay that with monetary demand. When people lose confidence in currency systems, they buy gold first because gold is the established monetary metal. But there's always a second wave. The wave of people who say, I missed gold, but silver is still affordable. That affordability is psychological until suddenly it isn't. The timing element, everyone underestimates. Why does 2026 matter specifically? Because multiple pressure fronts are converging. We're not talking about one catalyst. We're talking about a sequence where each trigger amplifies the next. First, mining output has been disappointing. Not catastrophically, just consistently underwhelming. Existing mines are aging. Ore grades are declining. New projects are fewer and slower to develop than the market anticipated 5 years ago. This isn't a sudden shock. It's a slow grind that tightens the available float every quarter. Second, above-ground inventories that were built up during previous decades are being drawn down, not emptied, drawn down. The buffers that used to cushion temporary demand spikes are thinner, which means when demand does spike, there's less slack in the system to absorb it. Third, we're entering a phase where global instability is no longer theoretical. Currency debasement is accelerating across major economies. Debt levels are at historical extremes. Geopolitical fractures are widening. When instability stops being news and becomes the baseline condition, people change behavior. They start treating tangible assets differently. And fourth, the people who understand market structure are noticing something eerie. The usual suppression mechanisms are requiring more ammunition to achieve smaller results. It's like pushing against a door that used to open easily. And now it barely budges even when you lean into it with full force. That's not random. That's what happens when the market is fundamentally repricing and the old control systems are losing grip. The paper versus physical paradox. Let's address the elephant in the trading floor. Silver trades in two worlds simultaneously, the paper world and the physical world. And those two worlds are starting to diverge in ways that create massive opportunities and massive risks, depending on which side you're on. Paper silver is what trades on exchanges, contracts, derivatives, claims on silver that may or may not be backed by actual metal. It's efficient for trading. It provides liquidity. And it allows for price discovery at scale, but it also allows for something else. It allows for the creation of silver exposure far beyond the available physical supply. Physical silver is the actual metal. Bars, coins, rounds, the stuff you can hold, the stuff that has weight and takes up space, the stuff that cannot be created with a keystroke. And here's the critical point. When everyone's happy to trade paper, the system works fine. But the moment a meaningful percentage of paper holders say, I want the actual metal, the whole structure gets stress tested. We're not at that breaking point yet. But we're seeing microfractures. Premiums on physical silver have been elevated for months in certain markets. Delivery times have stretched. Certain products are periodically unavailable, even though the spot price suggests abundant supply. These are early warning signs. And here's the mechanism that matters. When someone sells paper silver to push the price down, they're creating a price signal that says, silver is abundant, sell. But if physical buyers treat that lower price as a sale and start absorbing metal, the paper seller eventually has to reconcile the disconnect. They can keep selling paper until someone demands delivery. And that's when the game changes. The regional price fracture scenario. Here's something most people don't think about until it's too late. Commodities are global, but markets are regional. And when stress enters the system, regional prices can diverge dramatically. Imagine this scenario. Europe is energy constrained and struggling with industrial production. Suddenly, silver becomes scarce in European markets because supply chains prioritize regions with higher profit margins or stronger industrial demand. European buyers have to pay a premium to attract metal from other regions. Meanwhile, North American markets still show normal pricing because supply hasn't been disrupted there yet. What happens? Arbitrage. Traders buy in North America and sell in Europe, pocketing the difference. That sounds fine until you realize that arbitrage activity drains the apparently normal market, tightening supply there too. Once regional pricing splits meaningfully, it's very hard to put the genie back in the bottle, because the arbitrage activity itself creates the supply tightness that justified the higher regional price in the first place. It becomes self-reinforcing. This is not speculation. This has happened in other commodity markets during stress periods. Nickel in 2022, palladium in previous cycles, wheat during harvest failures, the pattern is consistent. Stress begins regionally, arbitrage spreads it globally, and suddenly the world price becomes a theoretical concept, while actual transaction prices vary wildly by location and urgency. The substitution and myth. Let's kill a popular misconception right now. They'll just substitute something else for silver. Sometimes yes, often no, and never quickly at scale without consequences. Silver is used because it performs. It's the best electrical conductor among accessible metals. It has unique thermal properties. It has antimicrobial characteristics that matter in medical applications. It has reflective qualities essential for certain optical and solar applications. Can you substitute? Sometimes. Copper conducts electricity, but not as well, and that efficiency loss matters in high-performance applications. Aluminum is cheaper, but it doesn't have the same properties in critical uses. Gold conducts beautifully, but costs 25 times more. Platinum works in some cases, but is even more expensive and more scarce than silver. Substitution is a trade-off. You lose performance, or you increase costs, or you accept lower reliability. Industries make those trade-offs when they have to, but they resist them as long as possible because re-engineering products is expensive, time-consuming, and risky. And here's the kicker. Even when substitution is technically possible, it takes time. You can't redesign a product line overnight. You can't retool a factory in a week. You can't requalify components with customers instantly. So even if substitution is the eventual answer, there's a window where demand remains inelastic. And that window is where prices can spike violently, what actually triggers the next phase. Markets don't break in straight lines. They break at inflection points, moments where behavior shifts. So what would trigger the next phase in silver? Option 1, a visible shortage, not statistical, visible. The kind where mainstream media reports that people can't buy silver coins at dealers, or that industrial buyers are publicly complaining about supply constraints. Once the crowd sees shortage, psychology flips from I can buy any time to I need to buy now. Option 2, a currency event. A major fiat currency faces a crisis. Could be debt default, hyperinflation, capital controls, banking system stress. When paper money gets questioned seriously, people flee to tangible assets. And silver is the tangible asset that's still accessible to regular people. Option 3, a delivery default. Someone demands physical delivery on a large contract position, and the exchange can't deliver. They settle in cash, or they change rules, or they delay. That event would shatter confidence in paper pricing and force a repricing of physical premiums. Option 4, geopolitical supply disruption. A major silver-producing region faces political instability, export restrictions, or conflict. Suddenly, expected supply doesn't arrive, and the market has to ration existing inventory through price. Any one of these could be the spark, or it could be something we're not even considering yet. The point is, when a market is fundamentally tight, it doesn't take much to tip it into chaos. The miner's dilemma. Here's something counterintuitive. High silver prices might not produce as much new supply as you'd expect. Most silver isn't mined by dedicated silver miners. It's mined as a byproduct of copper, lead, zinc, and gold operations. The decision to produce more silver often depends on the economics of those other metals, not silver itself. Even pure silver miners face constraints. Permitting takes years. Equipment is backordered. Skilled labor is scarce. Environmental regulations add cost and time. The supply response to higher prices is slow, measured in years, not months. And during that lag, the market balances itself through price alone, which is where you get the violent overshoots. What you should actually watch. Forget the price for a moment. Price is a lagging indicator when the real action is happening in the plumbing. Here's what matters. Watch premiums on physical silver. When premiums spike, it means people are paying significantly over spot to secure actual metal. That's demand exceeding immediately available supply. Watch delivery times. If you order silver and you're told it'll arrive in 3 weeks instead of 3 days, that's a signal. If dealers start saying, we're out of stock, backordered, that's a louder signal. Watch the gold to silver ratio. Historically, silver tends to outperform gold during the manic phase of precious metals rallies. When that ratio starts compressing aggressively, it's a sign that silver is playing catch-up, and silver's catch-up moves are typically violent. Watch exchange inventory levels. When reported inventories drop consistently without replenishment, it means metal is leaving the system faster than it's entering. That's structural tightness. Watch for rule changes. When exchanges modify margin requirements, delivery procedures, or contract specifications, they're responding to stress. Those changes are not random. They're defensive moves by the guardians of the paper market. The risk nobody wants to discuss. If you hold paper silver and a real shortage develops, you might get paid in cash, not metal. The contract settles financially based on the settlement price. Which sounds fine until you realize the whole reason you wanted silver was because you were worried about dollars. Physical holders don't have that problem. If you hold the metal, you hold it. Nobody can settle you out unless you choose to sell. But physical has its own risks. Storage, security, and liquidity challenges both have roles. But conflating them is dangerous. Where we go from here. 2026 could be the year the market reprices. Or it could be another year of coiling. Nobody knows with certainty. But what we do know is that the fundamentals are tighter than they've been in decades. The buffers are thinner. The suppression mechanisms are less effective. The industrial demand is relentless. And the monetary backdrop is increasingly unstable. That's not a prediction. That's an observation of the board state. And when you're looking at a board state, this loaded, small moves can create big consequences. So if you're holding gold or silver, understand why you're holding it. If it's speculation, manage your risk accordingly. If it's insurance, make sure you actually have the metal, not just a claim on it. If it's diversification, know what scenarios your position protects against and which ones it doesn't. And most importantly, stay rational. Markets can remain irrational longer than you can remain solvent, but they can also snap faster than you can react. The key is preparation, not prediction. If you want me to keep tracking these developments, subscribe and stay connected. And drop a comment. What do you think breaks first? Physical premiums, delivery times, or a regional price split? I want to hear your take.